Now, today's topic, we're going to talk about the capital budget, continue the previous topic, capital budgeting. Okay, last class we discussed about net present value, payback period, IRR. Now, just another thing we're going to talk today is this one is called annualized NPV, ANPV. Okay, annualized net present value. What this thing is actually. So you can see here that we are giving you the example, the formula as well, annualized NPV. But what is this? That's a good question comes up. How do they mean this thing, the annualized net present value? So what they say here is that normally net present value, what we do, we're gonna check. Like in example in here, if we go take you to this example, look, in net present value, what we do, we actually like two projects in here, project E and project F, two projects we have here. And in these two projects, look, very interesting thing, this project has life of 5 years. This project has a life of 3 years. Two project E and project F, two projects in here. One project has a life of 5 years, another project has a life of 3 years. Now, the thing is this, like, what is annualized net present value? So we actually, what we did in net present value, in net present value, we actually bring all these present values, calculate the present value of all these figures. Okay, all these are all your future values, future cash flows. Okay, so what we did, we actually calculated this future value as on today, value of this future and future cash flows. What is the present value of this future cash flows right now today? That's what we have done in here. And we found that here you can see that net present value is 12.35, that we can see here, net present value is 12.35. We see these things. Okay, 12.37. That's the thing we have seen these things here. And for project F, we see here it is actually 8.74. You see that here as well. So it's all good. Okay. Now, if we check what is annualized net present value, this says I will explain it in a very easier way I can. Okay, but see what it says here. Okay. So this says here that if projects are not ongoing means that sometimes it happens that not all project needs to actually go through for lifelong. No, sometimes the project stops. So this says if the projects are not ongoing, it is simply a matter of choosing the project with the highest NPV. If the project is not ongoing, then you have to choose which project has the highest net present value. We pick that project. Okay, and an ongoing project could be, for example, investment in a particular type of machine that has to be renewed every few years. Sometimes this is called the constant chain of replacement assumption. So ongoing project means like you keep on going. Every year you have to renew the machine, you have to replace the machine, something like this. But not all projects are ongoing. And they said here, let's look at here, unequal lives. So it happens sometimes that both the project does not have the same life length. Like in this example, look, they do not have the same life length. It has 5 years length, this one has 3 years length. Now, how do you, there is more than one way of comparing. Okay, now this says how do you calculate that? I've given you the steps in here. How do you calculate it? Anyway, when you will solve one problem, you will see how the steps are being shown to you as well. So nothing big deal there. Okay, now what they did, what does it mean actually? It means that we will find out an annuity value. We'll find out a present net. Again, you're going to find out net present value. That's true, but that net present value will not be just for 1 year. Like here, we can see here 12.37. We understand today we invest for the project E. Oh, both the project is $70,000. You're gonna actually making the investment $70,000, and it's gonna give us some money back every year. And present value is actually showing, and you can see that all these figures are not equal. It means they're not annuity. Okay, and what we found that net present value is 12.37. It means that our total value, present value of total cash flow, present value of total future cash flows are actually 82.37. Our investment was 70. So we have a net present value of 12.37. This is our net present value concept. I understand this one. We all understand this very simple concept. Now, annualized on this says we will find out such a figure which will be future cash flow. We'll find out a net present value of future cash flows. Okay, I think I should not say net present future cash flows. We'll say this way. Net future cash flows. I'll say that. Net future cash flows. How much will be our net future cash flows? And that will be in annuity term. How do they mean? Look at here in this example, this says here is what will be the annuity values. So this says the annuity value is 3.27. They got it here. If you guys can see it, I'll make it bigger. So look at here. They have it as 3.27. See that? This is you got here 3.27. So what does this 3.27 mean? It means that for project E, every year you have a net present value of how much? 3.27. So how does it mean? Let me make it this way. Let me show you guys this. Like 3 years, 5 years. So this year, the net present value will be, I'll write down here, 3.26. 3.26. Okay. This year, 3.26. Okay. This year, 3.26. Here, here, 2.6. So this is your cash flows. But this is, you see, every year you are actually getting 3.26, 3.26, 3.26. You're getting this. This is also your net present value in every year. So if we calculate all these future net values in today's, it will be equal to this 12.37. That's what they mean. How do you mean by this? So we are saying that here, that all this 3.27, 3.27, 3.2, all this are future, they're coming in future. These are my future cash flows, net cash flows, okay, which will be the present value of all these future cash flows, and today will be equal to our net present value. That's what they mean. Okay. So these things are, we call that annual annuity values. So what will be your annual annuity values next 5 years? So this 3.26 you can call it annual net present value or annual annuity values. So why you call the annuity? Because all of them are same. All of them the same, equal payments. You see, and equal payments. So if you take a present value of all these future and all these annuities, it will be 12.37. Okay. So yes. So this is your annual. So how did they say these things? They say annual, you can say this way. The annualized net present value actually tells you the project's net present value. Okay, it actually converts the net present value. Look, the net present value is 12.37. This 12.37. Okay, so it will be restating this 12.37 into annual annuity values for next project life, 5 years. Okay. For this one, 30, this one, look, it will be actually 3.51. 3.51. You can see that. Okay, 3.51. And net present value will be how much? You can see here, this is actually 12.37. And this one, you can say that as, this one is 8.74. 8.74. Okay. Now, if you guys want, you can actually calculate. You can actually calculate your, and even if you check these things, if you check these things like with using annuity table, annuity formula, you will see it. You will get that 8.74. You'll get that figure. How we can do that? Easy. Look at annuity table. Let's have a look at our annuity table. Okay, it will be annuity, ordinary annuity. Okay, don't forget this. It will be ordinary annuity. So here is annuity table. Present value annuity table. Okay. Yeah. Don't have it on PDF. Present value. Here it is. This one you can find from here too. So if you see here, present value, future value interest factor $1 compounded. Not this one. This table is present value interest factors for $1 discount rate K percent of period. The present value. This is my annuity one. Future value annuity. Future value. Yeah, this one. Okay, look at here. Present value interest factor for annuity. Okay, so what is our rate? Let's do the calculation here. For this one, our rate is here 10%. Good. 10%, 5 years. Look at here. 10%, 5 years. 3.7908. Okay, look, 10%, 5 years. 3.7908. Okay, so multiply it. 3.7908 multiply it with, the first one is our 3.26, right? 3.26. So this one multiply it with 3.26. See, 12.35. It's a rounding error. Okay, this is the one. So you can see that. So these are annuity factors. Multiply it with the annuity, you'll get the figure. Then for the other project, another project is 10%, but this one is 1 to 3 years. Okay, this one is 3 years. So let's see, 3.51, 3 years, 10%, 3 years, 1, 2, 3 years is in here, 2.4869. So cancel this out. 2.4869. Multiply it with 3.51. 3.51. See, 8.72. Okay, you can see that here. So we'll go back in here. It is your, see, 12.30, 8.74. So what we actually get in this 3.51, 3.51 is our actually annuity value of this present value, net present value. Okay, so what they mean like every year you're getting 3.51, 3.51, 3.51 of your net income, net cash flow, you can say that. Okay, so this is your annualized net present value. Okay, let's go back. All right. So what now you can say, ask the questions here. The question is, what is annualized net present value? Okay. So did they give any definition? Actually, no, they did not. Okay. Okay. Anyway, you can say that the annualized net present value is actually your annuity value of the net present value for how long? For the life of the project. If the project is 5 years, 5 years, 3 years, 3 years. So how do we get these things? Why do we do these things actually? We do these things because here we're actually combining, look at here, two different lifespan of the project. One project is for 5 years, another project is for only 3 years. Okay, so now how do we compare them? We compare with the annuity, how much you're getting on each year. 3.51 and 3.26. So even look at here, if you notice about net present value from the net present value point of view, we would say, oh, okay, 12.37, that's our highest net present value. We'll go for this project. But if you notice on actually annualized net present value, we actually go for project F, not project E. Even it's 12.37, but here, look at here, this one is to 8.74. So if you consider about using net present value method, then we would be actually choosing project E. This project we would be choosing. But if we follow annualized net present value method, like this one, which is annualized net present value method here, okay. So this is your actually, this is telling about how much, 3.26. But if we choose annual project F, we are actually getting 3.51. So if we choose annualized net present value method, we are actually choosing project F. So it depends on which method you follow. Okay. Yes. And here is the formula, how to calculate it. So net present value multiplied by R, your rate. Here is that rate is 10%. This is 10% per annum. Rate divided by 1 minus 1 plus R to the power minus N. Okay. So that's the formula. N is your number of years. For project E is 5. Project F, it is 3. Okay. Yeah, it is 3. Now, we move on to the next one, risk and capital budgeting in here. In this case, we'll be talking about, they have a couple of things here, like this says, when we apply a firm's cost of capital to discounting, like this says very nicely, they said here at the beginning, when we apply a firm's cost of capital to discounting cash flows from various projects, we are implicitly assuming that the level of risk associated with the project cash flow is the same as that associated with the firm. So when we are actually we are considering our risk, we are actually applying the firm's cost of capital. Okay, we're using firm's cost of capital to discount the cash flows from various projects. So let's say you have a new project. Okay, your farm is doing very good. Farm is very nice farm, very good farm. There is not much risk involved with the farm. Okay, then what you did is this: you are actually applying. In this situation, you are actually going for a new project. And the new project, when you have the new project, we are actually assuming the new project risk and the farm risk is same. We are using the same risk. We are assuming that the farm and the new project is same. Look, this may not be possible sometimes. It may not be correct, because a good farm, a farm without no risk, a riskless farm, okay, no risk at all, that type of farm even take a project which might be risky. So can we say that the farm doesn't have risk? Does it mean that the new project will not have no risk? Not necessarily all the time, it's true. So this says here, risk and capital budgeting. The risk associated with a given investment project is essentially related to the risk that projected cash flow will not be realized. There are number of ways to, okay, there are a number of ways they're talking here. So one of the ways is called sensitivity analysis. sensitivity and scenario analysis. So there is two types of things in here. One is in sensitivity, in scenario analysis, the sensitivity of results of a whole set of variable changes is measured or guessed. Okay, this says here, in sensitivity analysis, sensitivity of result to changing one variable. In sensitivity analysis, what you're doing actually one variable. Remember this one, changing to one variable. You're sensitive to one variables. And they said often three basic cases of variable are analyzed: expected value, okay, most likely to happen, best or optimistic situation, and pessimistic situation. So what they say here is this: we are actually going to give you cash flows of three situations. Okay, cash flow of three situations. What are the three situations? If the economic condition of the country is very good, sorry, what will be the cash flow? The situation of the country is bad. Like, look, cash flow doesn't necessarily mean all the time, depends on one variable. No, not necessarily. It depends on so many things. So if you harmonize them all, if you bring up all of them in holistic manner, that time what happens is this. Look at here, the example they gave here. There is a project, sensitivity analysis, capital budgeting. Let's go into sensitivity analysis. Let's bring the whole example in one page. It will be nice to look at. They said consider mutually exclusive two projects, project G and project H, two projects we have in here. Okay. So we are actually checking on net cash inflow. We're checking on the net cash inflow. Okay. Now look at here, net cash inflow. We have pessimistic situation, very bad situation. Project G will give us 5,000 millions, whatever it is. And then you talk about project H will give us 2 in a very bad situation. Okay. Most likely we're gonna get 10, both of them same. If it is very good situation, very optimistic situation, that time project G is gonna give us 15, but project H is gonna give us 20. So this is your initial investment. So we have two projects, project G and project H, two projects we have in here. Okay, and these two projects, okay, if the situation is really bad, so they're giving us the three situation here: pessimistic, most likely, and optimistic. Three situation they gave us in here. How much will be our cash flows? And net present value of these three situation, we'll consider, we will calculate these things by us. It will calculate it by a formula. So this much will be given to you: initial investment and the cash flow in three situations. Okay. So they say each project has a life of 10 years and the farm cost of capital is 8%. The information is given to you this much. Red things, no. You can calculate that. So pessimistic net present value, how are you going to calculate this one? That's not working. Yes. No. Okay, I'll make it bigger then if it's not opening up in bigger. Okay. I'll make it bigger. You see it here. 15 is our optimistic net cash inflow. If you go up, optimistic situation. See, 15 is a project G. Our 15 is our net cash inflow for 15. So what we are trying to calculate, the net present value from cash flow. So 15 is our net cash inflow. Okay, and you can see summation of t is equal to 1 to 10, so 10 years. 1 divided by 1 plus 8 to the power t minus 50. This is our formula actually. So by using the formula, I put the values in there. So this is the, so when you have these things, like this is your main formula, okay? But when you actually distribute and break it up, it will be coming up this way.
Our lifestyle now is a lot of sitting, not very much activity, and unless you're an athlete, you're not going to
Okay. Sarah Jebin, I think I will mute you all guys. Okay, some of you are giving me some background noise. Let me mute it. Okay. So now you see these things here. So net present value for optimistic situation, you use this formula. Okay. And your number of years is 10. Okay. So this is the formula you have. And the answer you get is 50.65. So that's how you actually calculated. That's how you calculated this net present value of 3 situations. So you have to calculate the same thing, most likely NPV. So most likely situation. Okay, I think I will write down situation. Okay. So you can understand it better. So you have given here the 3 situations, project G, project F, and NPV range. You can see the 67. How did they get it? So add them up all. Okay. And we range 67 to 120, like this type of things will come up. Okay, now let's move on. Another method is called simulation method. Okay, a lot of methods. I'll go to the next method actually. So I'll go into the next method for you here. This is interesting one. Risk adjusted discount rates. This is interesting one. The risk adjusted discount rate. This one, this says here. So this says method account for risk and the time values of money in one measure. In this case, we're actually bringing up risk and also time adjustment, time value. Two of the things. Okay. Mm. Okay. Mm. So now, so in this case, we're actually adding up risk and the discount rate both. Okay. So it says you're using this method, NP formula will become like this. That time you do not use the interest rate, you will use risk adjusted discount rate. Use this one will be using this rate you're gonna use. Okay. So now let's look at one formula in here. Okay. Another thing that says here, very interesting one that says, okay. Okay. If real corporate assets are traded in efficient market, this is very interesting reading in here. Okay. If real corporate assets are traded in efficient market, the radar, the RADR, risk adjusted discount rate of a project could be determined by using CAPM, capital asset pricing model, and an estimate of the project's beta or non-diversifiable risk. So the beta we use on the CAPM is actually our non-diversifiable risk. Okay, which in this case would be the only relevant risk. However, such assets are not traded in efficient market, and therefore project risk is usually determined with references to the project total risk measure. In practice, risk adjusted discount rate is determined with reference to an estimated relationship between total risk measure, total risk, sigma, which we actually calculate by using standard deviation, and market risk return. So you can see this is actually a linear equation. This is actually your linear equation. Okay, so you can see this is a straight line. So it means it's a linear equation. This says. Generally, it assumes that the market risk return function is linear. The problem with the RADR method is, of course, the estimation of the market risk return function. How do you actually estimate this one? This is the problem we have. Okay, that's the only problem we have, as it is difficult to practice. It is difficult in practice to estimate the market risk return function. Firms often classifies projects into a finite number of risk classes, each of which are okay. All right, let's go move on in here. Okay, now let's look at this project. Two projects we have, project A and project B. Suppose for our previous project A and B, okay, project A and B is coming from actually from last week. Let's see if I can get back to the last week's file. It's not here. The recent file. No, it didn't. We can actually get this thing, so let me get it from. It should be on 22. Yeah. Okay. So our project A and B. Yeah, project A and B. So this is our example. Let me actually take these things so that. Okay. This is our project. Okay, two projects, project A and B. So here is talking about our return is how much? 12% and 11%. Calculate the net present value of this project using RADR method. How do you do that? It's exactly the same thing. You just have to use 1.12% your RADR, okay, as your interest rate. Our interest rate was how much before? Okay, they did not say here how much. Oh, 10%. It was 10% before. Okay, so is it both project? Yeah, both the project 10%. I can see that. Okay, yeah. So in this case, we are using actually 12%, and project B is 11%. And then you will find that it is actually different. It is how much is that? Our net present value is 8.08. Before how much it was? I think it was 12.37, and this one was 8 point something. 12.37 or 11.46. Two projects. So it was our two projects. One of them was 12.3, another project was, and PB was 11.46. But if we use RADR method, RADR rate, which is a risk adjusted discount rate, which is 12% and 11%. So then our net present value also changes. Okay. So in this situation, project B would be chosen. But if we use the other method and net present value method in here, then it would be, we've chosen project A. Project A would have been chosen. Why? It has 12.37 higher net present value. Then it has higher net present value than the other project. Okay, you can see this. So this one. Yeah. So if we use normal NPV, net present value will be chosen project A. Okay, we're choosing project A. But if we choose RADR method, risk adjusted discount rate method, that time we're using actually project B. So you can see it very clear that depending on which method you are using, depending on the method, you will be choosing your project. Okay. Now, let's go into our cash budget now. Okay. Let's get back to our cash budget now. Okay. In this case, this says basic cash management. How do you manage your cash? Two things we'll be discussing here. One of the things we'll be discussing operating and cash conversion cycle. This one we'll be discussing. And also we'll be discussing another one. So cash conversion cycle in here. And this is your operating cycle OC. And we'll be talking about the cash conversion cycle. These two things you're gonna look at. And what else are we gonna see? This is the Bosco company. And this another one we'll be discussing about. There's nothing much actually. Cash management technique. Another topic we actually discuss here is this. Okay, let's talk these one first, these two first, then we'll come up in here. Okay. Okay, the operating cycle, the first we talk about operating, what is operating cycle? It tells you that operating cycle means time from the beginning of the production process to the collection of cash from the sale of finished products, which is actually how long, it's a time. This is called how long you will need. Okay, how long you will need, the time from starting beginning of the production process to till you sell of the finished good, how long it takes. Start of the project to sell. This is called operating cycle. And cash conversion cycle means the time the firm's cash is tied up between payments for production inputs and receipt of payments from the sale of resulting finished good. One is starting of your production process, beginning of the production process. And here, how long your cash is tied up, the money is tied up between the payment for production input and receipt of payment from the sales. So look, why it's different? Because the business is done on credit. Why it's different? It's different because business is done on credit. So even if you start, like your production process starts today, your payment, you might start the business today, and all the material that you're using, the inputs you are using, maybe you bought them on credit. And this payment you will make after 1 month. It's not the same time. Also, you make a sale after 3 months, but you receive your sales money after 4 months, 5 months. You don't know how long your credit terms. Okay, that's why two things here. Operating cycle one is that time. Okay, time. Another one is time for production process to till the sales. Another one is making the time of cash to be tied up. Another one we're going to talk is about how much money will be tied up. That's what we will talk about here. Okay, anyway, so maybe not as a heading, but we'll talk about that too. I think here. So this one will tell you about how much money will be tied up. Okay, we'll talk about that too. So one is time, another one is money. Let's say here. Yeah, amount of resources invested in cash conversion cycle. These things we'll be talking here too. Okay, how much money is being tied up. These two topics we'll be talking here. Anyway, let's move on. So how do you calculate these things? So they say operating cycle is equal to average age of inventory, AAI. What is that? Average age of inventory plus average collection period. Two things. Average age of inventory and average collection period. Okay. All right, here you are assuming 65 days per year. So this is the formula we have. So how do you calculate AAI? AAI formula is this: 365 divided by annual cost of goods sold divided by average inventory, and average collection period is here. Average account receivable divided by annual credit sales by 365. So these things, actually, these formulas you have already seen this formula when you guys been working on ratio analysis from there, coming from that chapter, ratio analysis chapter. Okay, so we have to calculate these two separately, AAI and ACP. Calculate these two separately and add them up. That's it. Okay, and for this one, okay, this is cash conversion cycle will be actually cash conversion cycle CCC is equal to OC operating cycle minus APB. APP. What is APP? Average payment period. Okay, APP. Average payment period. Did they say anyhow? Yeah, average payment. No, it didn't say anyhow. APP. Oh, here, average payment period here is mentioned. Average payment period. Okay, app. Okay, so cash conversion cycle is equal to, so first you have to calculate operating cycle minus average payment period. So how do you calculate average payment period, APP? This is the formula: average accounts payable divided by accounts average credit purchase per day. Okay, divided again by 365. So three things you need to calculate here: AAI, ACP, APP. These three formula you will need. Okay, to calculate these two items. Okay, let's have a look on one example we have done in here. This is the example we have here. Consider again the case of Bosco company, for which the investment statement and balance sheet are reproduced below. So here is your income statement and here is your balance sheet. They have given you here. And what you need to do, calculate the Bosco operating and cash conversion cycle, operating cycle and cash conversion cycle, OC and triple C. Assuming the end of year inventory figure is indicative of the average inventory value. All sales are on credit and made at a uniform rate throughout the year. Okay. All right. And here I mean, okay. Annual credit purchase can be approximated by annual cost of goods sold. Okay. So this is that you'll go, okay. All right. And here, AAI, this is the cost of goods sold average inventory. Okay. So let's do this one. AAI 365. AAI, what is AAI? What is AAI? Yeah. Average age of inventory. This. So 365 divided by 610 by 1. How did they get cost of goods sold? So look, cost of goods sold is given here. Less cost of goods sold, 610. And this is average inventory, average accounts receivable inventory is 164. Look, if it happens that they gives you, the opening inventory and closing inventory, but not the actual inventory figure, that time you have to take an average. Okay, if they gives you opening and closing inventory, it should be actually your average you have to take. Okay, and what else are talking in here? Okay, so it's 98.13 days. And ACP, average collection period. So average account receivables. average account. So if they give you opening account receivables and closing account receivables, then you need to actually, opening and closing account receivables, you need to actually get the average. If both the opening and closing is given, then you have to take the average. Okay. So average account receivable 62. Account receivable is 62 here. And your annual credit sales 750. Your sales figure is 750. So this says here, while all the figure is on credit, this says here, according to customer cycle, assuming the end of inventory figure indicative of the all sales are on credit. You see that mentioned here. All sales are on credit. So this total sales is on credit 750. And made a uniform rate throughout the year. Okay, now let's move on. With 365 is equal to 30.173 days. Therefore, OC operating cycle equal to 98 plus this. It will be 128 days. So it means that the company has need 128 days from the beginning of the production process to till the end of, to start the sales. 128 days. And about this payment period, let's go in here. So you know the, cash conversion cycle, operating cycle minus APP, APP, average payment period. It says average account receivables, average accounts payable divided by annual credit purchase. Okay. It is 610, 50 divided by 610, 365. Average accounts payable is 50. Average accounts payable is 50 divided by annual credit purchase. Where is the purchase? Purchase is should be in here. Cost of goods sold. Where is okay, accounts payable? I think they use the accounts payable as the purchase in here. 50. Credit purchase 610. Which one? Which figure they? They use the total cost of goods sold as credit purchase. So I can see for this Bosco company, okay, this company here, this is their first year. They do not have anything from the previous year, the first year business. That's why they don't have anything from the previous year. It's an example I can see here. So yes, so you get this one, operating cycle minus average payment period, which is 128.304 minus 29. Get this figure. So it's OC 128, which is in here, 128 minus 29. So they have 98 days, 100 days about for what? 100 is about for their cash tied up. Okay, cash tied up for 98 days. So they're showing you here, they're showing you a diagram in here. Okay, so AAI, how much is AAI here? 98 days. Okay, 98 days. AAI means average age of inventory. So inventory stays in 98 days. Okay, and they have SCP. How long is the SCP here? SCP is actually 30.173 days. So you can see from 0 to 98 days. And here it is SCP is actually with 30.173. So this figure. Okay. And average payment period is 29 days. Cash conversion cycle 98 days. Okay. So the diagram they're trying to show you a diagram. Okay. Now this says here there is a direct relationship between the length of cash conversion cycle, how long you need to keep your money, and level of resources invested in the cash conversion cycle, how much money you need to keep in there. Okay, how much money you need to keep in there. There's another thing they will be talking in here. So let's move on. They give an example in here. Suppose a farm produces a single product at a rate of one unit per day. Okay, a farm produces a single product at a rate of 1 unit per day. So every day you are actually producing one item. So the total cost of producing each unit sold is $1.50. The cost of purchases, raw material associated with producing 1 unit of output is $1. These purchases are made daily. So every day they are buying and purchasing these things. Each unit of output is sold for $2. Okay, each unit of output is sold for $2. And the AAI, age of inventory, average age of inventory is 3 days. ACP is 2 days. So they gave you this example, this information here. Or transaction are made at the beginning of each day. Determine how much on average will be tied up in tables. How much money is actually tied up. So this is the one we're going to actually check. How much money you need in there. So this is the diagram that shows you here. Okay. Day 0 is actually 150. Why 150? Because they said the raw materials you need to purchase is $150. Okay, 150, 1.5, it's $1.5 million. Okay. And day 2, see, again, you need another 1.5, 3. Day 3, again 1.5. Okay, 4.5, 4.5. So this says here. So account receivable. So let's go in here. This says a farm produces single product. Okay, the total cost of producing each is 150. So total cost of production 150. Raw materials raw materials actually $1 here. The total cost of production is 150, and their cost of purchase raw material associated with producing 1 unit is $1. So raw material cost is $1. These purchases are made daily. Each unit of output is sold for $2. So selling price is $2. Okay. So average is actually 3 days. So that's why 3 days has been added up. Okay. So 0, 1, 2, 1, 2, 3, 2, 3, 4, like this. 3, 4, 5, like that. You'll go in. Okay. So inventory will be staying for 3 days. Inventory will be staying in there. Okay. So so the formula is what the formula we have here. Inventory plus account receivables minus accounts payable. That one will give you actually how much cash you need. Okay. On every single day. So tied up in cash conversion cycle is so 150 minus plus account receivable is. So now when you make the sale from 3rd day, because after 3rd day, your inventory tied up in 3 days. So after 3 days, you start to sell every day 1 unit. So these 3 days will be your 3 days will be your first. You will be OC, operating cycle. Okay, it's 3 days OC because 3 days are the time you need starting the production until you make the purchase. Okay, when do they start to get the money back? OC is 5 days. So OC is 5 days, actually 2 days OCP, 5 days. When they start to get the money back? No information about when they get the money back. All right. So I think I'll stop it here. It's almost 6:30, 35. Okay. Anything else in here to talk? No. Consider again the case of Bosco company. Supposing the value in the balance sheet or inventory accounts levels. 176 million. Okay. So resources invested in there. So cash conversion cycle will be how much? Again, the same thing will come up. Inventory plus account receivables minus accounts payable, 176 million. So this is the formula actually. So the formula here is given. I'm going to say inventory plus account receivables minus accounts payable. That's the formula. Okay. Yeah. Inventory is 164, accounts receivables 52, accounts payable 50. So it will be around 12, 164 plus 12, 176. Yes. Okay. The next, the text on this section for covered in the lecture. The cash management techniques is not actually covered in the lecture. I'll stop it in here. Okay, so today we have we have to do some questions from the previous week. Okay, some problems we'll be solving from the previous week as well, but they're not very big actually. They're very small, not very large problems. We'll be talking about this one. Okay, yeah, click on NPV, net present value. Okay, let's go back to our previous week. Thinking this one answers. Okay, so 6. Yeah, I think we have done till 7, right? 8, 9, 10, 11. For example, so this one you guys have to be looking after. Okay, these 5 questions it says here for the exam purpose. They said additional questions will not be discussed. Let's make it bigger. So this is additional question they have given you here. You guys can actually work on these things. And textbook GJF, I think it meant Gitman Joshua Flanagan. That's the writer name, initial of the writers, 3 writers. Okay. So these things is important for you guys to look at, which will not be covering up. What is efficient market hypothesis? We'll talk about that. I think I'll cover, I think last week we did till 7, right? Today we'll be covering 8, 9, 10, 11. Okay, let's talk about what efficient market hypothesis mean. Okay, all right. Efficient market hypothesis means this, that look, before I go ahead with efficient market hypothesis, what does it mean? I want to talk a little bit more about the market, okay, how the market system works. Okay, so this says here, the hypothesis says here is this. When you purchase a share, when you purchase a bond or a share from the market, you are actually not sure that the price you are paying and the value of the share is same. The price you are paying, let's say Apple computers now, the share price around $200. Is it? I think it's $200. Okay. So now if you go Yahoo Finance, let's see going here. Just 278, $300. Okay, it's growing slowly. So now the question is, the price is 278, but the question is, do they have that much value? That's the big question comes in here. Do they have that much value? So the value and the price may not be same. Why is that? Now, the problem is because market is not efficient. The price we pay, it might happen that the price we pay is not representing, the price we pay is not representing actually the value of the item. It happens. Okay. So now let's put this way. What is efficient market hypothesis? Efficient market hypothesis tells you when the information, all the relevant information which might have an impact on the share price, okay, are represented, are being reflected through the share price, then we call it market is very efficient. any information about the business, any information. So the three different types of information we have, okay? One is very weak form of market. When there is very weak efficiency, it means they actually use that, they actually estimate the share price using past data. Look at here. This is the daily data, daily past data of the share price, okay? 2018, 19, and all these years till December 1980, Apple Computer started to go on public. Okay, Apple Computers, they went on public on December 1980, the first time they did. Okay, and they have all the data in here. So now the question comes up, there is a lot of information came up, in between, like, so these are the past data that we have. These are also informations for you. By using this form of informations, when you try to estimate a share price, it means you have a very weak form of efficiency in the market. Semi-weak with the past data, plus you use publicly available data, publicly available information. What is publicly available information? Publicly available information means that annual report, minimum wage, annual report, the publicly available information. So the company is making a good profit. The company has made a good profit. Okay. So what happens is this: when the company made a good profit, the problem is this: share price is supposed to go up. The company make a loss, share price is supposed to go down. Why? Dividend matters. When they give dividend, when they don't give the dividend. And you will see that I don't know, I've showed you guys or not in the class, but Apple company did not pay good dividend. No, they did not pay good dividend. So like from 1980 to till 92, this time they made the dividend. Like first 7 years they did not pay any dividend. Like 80 to 90 until 1987, till this time they did not pay any dividend. After these things, 1987 to till 92 or 95 actually, they made the dividend. Again, they did not pay dividend till 1995 to 2012. No dividend. After 2012, they started to pay dividend again. So sometimes they give dividends, sometimes they don't give dividends. But this thing did not have much impact on their share price. It happens. So we have three different forms of efficiency: weak efficiency of the market, semi-strong efficiency of the market, and strong efficiency of the market. Okay, weak form of market, semi-strong form of market, and strong form of market. Three different market efficiency we have. So now, what is efficiency? When any information which might have an impact on the share price is reflected through the share price. It means good information, share price went up. Bad information, share price went down. But not necessarily all the time it happens. It means market is not efficient. The efficient market hypothesis means that we believe all the relevant informations are being absorbed into their share price, being reflected through their share price. That's called efficient market hypothesis. Okay. Now, let's do number. Okay. Based on the constant growth dividend valuation model, the relation between the stock's price and the current expected dividend growth and recurrent rate of return and the current dividend are as which one is the answer? A, B, C, D. Okay. Let's go in here. Oh, okay, let's talk it here. We form semi-strong form, a strong form of efficiency. Okay. All right. Okay, the answer is B is the answer. Why is that said here? Dividend growth model is this. Answers given below for the following question are guidelines only. Students will not get full marks for the answers given in all theoretical questions. This is applicable for all weeks. So yes, when you will actually give an answer, like theoretical questions will be answered, that time you will have to actually discuss in detail. Just don't give yes, no, this, like not like. You have to give a little bit of explanations in here. So here we have to talk about dividend growth model we'll be discussing now. Okay, so dividend will be growing. Okay, a growth, and this is G is the growth rate. Okay, let's go back to our week. I think that is from week 5 actually. You see, week 5, 6, 7 are very related to each other. Okay, so be careful about that. Let's go back to our exercise. The Gordon model you're talking about. And someone asked me about yield to maturity. Okay, yield actually nominal. Okay, yield to maturity of a bond is the annual interest rate, nominal annual interest rate, maturity. Maybe should not be hypothesis. Share valuation. So this is our dividend, normal dividend one, not the growth rate, normal dividend one. Share valuation model using the dividend method. Okay, future dividend one will be calculated back to as zero dividend growth. So this is not the one. Okay, here is the one, dividend growth model. Variable dividend. So dividend is actually variable. Sometimes will increase, sometimes will decrease. Okay. We'll be talking about constant one. Okay. This is the Gordon model, constant one. Okay. So we're talking here is about 1 plus G divided by RS minus G. So this is the one. So this is our Gordon model we're talking about. The dividend is equal to dividend this year plus the growth rate, 1 plus G. G is your growth rate in here mentioned. Where G is the assumed constant growth rate, and dividend is the most recent dividend paid. So when is your dividend is paid now or last year, D0 plus how much is growing. Okay, how much is growing. All right, and to the power T. So dividend on this year will be dividend in last year plus your growth rate. All right. So this one is normally we use this one, constant one. This is the one normally we use. And this is the finished sum of the geometric progressions. Okay, provided R is rate of return is actually greater than your growth rate. Of course, like if your return is 10%, growth is not 10%, growth is less than that always. Yeah, the problem with this method, of course, is that it may not be reasonable to suppose a constant return on equity. Yeah, not all the time the return will be always constant in that case. Okay. What else are we going to talk about? All right, next do number 9. For stock A, okay, this says here for stock A, find out the required rate of return if current year's dividend is 1.5 and expected dividend growth. Our expected dividend growth is 2.5, okay, and the value of share is 25. Our share value is how much? $25 the share price. So our P0, let's do this one, solve this one. I'll do it here. So our P0 P0 is equal to, okay, you can say our is equal to, how much is a P0? $25. Okay, or we can say, like, I can write down the formula straight. Price of 0 is equal to, will be D0 D0 okay, then P 1 plus G plus G divided by RS minus G. Okay, so you have to find out the required rate of return. Okay, that is how we're gonna write RS minus, actually I should do the bracket, RS, the rate of return, RS minus G, and bracket close. So this is our formula. So P0 is given, which is 25. So I can write it down later. Use a Newton equation. This, okay. You can say what P0 is how much? P0 is my 25 is equal to my D0 dividend. Current year dividend is how much? They said 1.5. We write down 1.5. Okay. And the fractions here should be our 1 plus growth rate. How much is my growth rate? Human growth is 2.5. So write down 0. 0.025, 2.5% divided by RS. I don't know what is my RS. That's what I'm going to actually find out. My RS minus G is again 0.025. Okay, so this is our formula, and what we can say here is equal to, what can we say? We can say 1.5. Okay, actually we should know, it should be 25 multiplied by how much? This one. I'm changing the side. Okay, this is equal to 1.5 multiplied by this. Okay, right? So from here, what can I say? So now, actually I can make this one down, this one down. Yeah. Now we can say here, is equal to this here divided by 25. Okay, so let's take 25 out. And we can say, we can take these things as well, like this 0.2, this one, whole thing I can take on the other side, plus 0.025. So if I take that to that side too, that's it. RS is equal to this. Okay, which you can say is equal to, how much should be the answer? 1.5, let me do it. 1.5 into 1.025. So 1.5 into 1.025 is equal to 1.5375. Actually divided by 25. Divided by 25. 0.061. Okay. Plus, so you can say here 0.061 plus 0.025. Okay, which is equal to 0.086. 0.086, which is 8.6%. Okay, you can say this one. Anyway, I don't know that I can say here straight. This one is 8.6%. Okay, this should actually double. Did I have that sign? Yeah. No. Almost equal. Okay, 0.86. So this is how we calculate number 9. And how about number 8? The current price of RIO stock is 25 per share. If RIO's current dividend is $1 per share and investors required rate of return, okay. If investor required rate of return is how much? 10%, while the expected growth rate of dividend for RIO based on the constant growth rate evaluation method. So same thing will apply here. Same thing will apply. We'll do this exactly the same thing, but this time we have to change these values. It will be exactly the same thing, but this time they are asking us to calculate. What to calculate? Growth rate. So growth rate we don't know this time. Okay. This time we do not know growth. We will say here, this is as G. We don't know the growth rate, but our rate of return we know this is 10%. So this will be actually 10%. So it will be 0.1 minus this will be just the growth rate. Okay, and the current price is actually 25. So pricing at the same 25. Current dividend is $1. So this is not 1.5. It's actually $1.01. Okay, $1. Okay. All right. So it will be RS will not be this. It will be 0.1, 10%. 0.1, 10% and minus 0.025. This one is actually USG. And this is actually USG. and your RS is actually, so it will be different this time. Candy is not 1.5, it will be just 1. Okay, so you can see this from here. Okay, we can make this things up. From here, we cannot use it anymore. It will be 0.5 in 2.5 into 10%, it will be 2.5. Okay, 2.5 minus 25G. Okay, that is equal to 1 into 1.G. So I don't make these things. It's just 1.G. Let's delete this out. Okay, equal to 1 plus G. That's it. Okay, so how much you get? From here, we can say that it will be 2.5 minus, so 1 minus 2.5. Let's change the side actually, okay? So it will be 3.5 equal to 26G, right? 2.5 come this side, it will 1.5 actually. What happened on Anmol core? Anmol deep core, everything all right? Okay, let's move on. So if we change the side, so it will be, let's say 2.5 minus 1, so it will be 2.5 minus 1 is equal to, it will be 25G plus G, which is 26G. Okay, so we can say here 1.5 equal to 26G. So here, so 26G is equal to 1.5. Okay, what's happening here actually? Okay, you don't have to tell me anything, to be honest, Anmol Deep. You don't have to ask my permission to leave the class actually, okay? Anytime you want, you can go, it's all good. Okay, so 26G is equal to 1.5. So let's bring it down there. 26 is equal to 1.5. And we can say, then we can say that G is equal to what? Go in here, and we can say G is equal to, I can put here like, here we can say 1.5 divided by 26. So which is equal to 1.5 divided by 26. It should be 1.5 divided by 26. 0.57692, right? 0.92. Okay. 0.0 is equal to 5.76. I would say 5.76. That's 76 or 77, I would say 5.77. That's the answer for your G. Okay, so G is equal to 5.77. Okay, so that was the thing we had from last week. Okay, the 8, 9, 10, 11 are efficient market hypothesis. So that's it. That's the solution you have it in here. And what else? Today's week, today is from the last week. And this week we'll have to do, this is Gordon model. And this week is our 8. We have to calculate these questions actually here. Okay. Calculate the NPV for the following net cash flow if the cost of capital is 10% per annum. Also calculate the payback period. Okay, eventually each year of the IRR of the project. So you have to calculate IRR, net present value, and all these things in here. Okay. All right. So let's do this one. So for the payback period, how much will you pay back? 60, right? So 10. Okay, we can do the payback period in here. How much will be the payback period? Let's start with the easiest one. Payback period is equal to, definitely will be 2 years, 42 plus 42 plus 10, so 2 years plus how much it will be? Creation. 2 years plus, plus we have 35. I don't need 35,000. How much I need? 8, right? So 8 divided by 35. So it will be 8 divided by, so I can actually do it in this way. So 8 by 35. So which is equal to 2 plus 8 by 35. How much it will be? Let me calculate it. 8 by 35. 8 by 35. 2285, 23 for example. So 2.23. Yes, payback period done. Okay. Then talking about net present value. Okay. Now we'll be talking about net present values. If you talk about net present value, we will say this. If I actually do these things, to be honest, it will take one question, will take me the whole day. I actually will, net present value internal database, okay, number 2, 3 is mishmash. Okay, so how big is mishmash? Okay, so mishmash limited wishes to choose between 2 mutually exclusive projects, A and B, each giving only one positive net cash flow at the end of the year, as the following table. Okay, and the IRR of each project. Okay. Well, the IRR of this project. That is also very long one. Okay. I think I'll open the solution. That would be good. There is no solutions. Okay, let's see. I'll get the solution manual for this. I don't think I will be actually typing all this. I don't think I'll be typing all these formulas right now. It will be taking too long time. I'll show you guys how did it work. Yeah, the payback period is 2.23 is fine. Another thing. Okay. So now, if you look at here, net present value, how much is net present value? Okay. All right. All right, so this is here so this first year is 10,000, second year 42, third year is 35, fourth year is minus 10,000, and the initial statement is 60,000. Okay. All right, so you have to calculate the net present. So cash flow divided by 1 plus r to the power n. That's the formula they have used. 1 plus r to the power n. This formula they have used here so far. You can see 10,000 divided by 1 plus r is 10% in here. Okay. 1.10, 10%. Okay, and they got it at 10%. Second year, look, r square. So second year, our cash flow is how much? 42. So 42 by 1 plus r to the power n. Third year, 35 by 1 plus r to the power n. Fourth year is minus 10. So we did the minus figure. And this is our initial investment to be subtracted, the initial investment. That's it. So your net present value is 3,267.54. Payback period, I already showed you payback period. And net present value, okay, net present value. So this says when you calculate IRR, okay, when you calculate IRR, okay, the net present value is actually, they said, will be equal to 0. At what rate the net present value will be 0? That's what they're trying to. So look at here, like I told you last class that it is a trial and error. Okay, it's a trial and error thing. What happened, Putik Panha? Some of you guys are waiting for the attendance. Let me do the attendance first then before I solve this. Okay, let's finish this one. That one I have touched just now. It will take 2 more minutes. Finish it off. Then I'll have 1 more question to go. We're going to finish it off anyway. So they tried the RPB as they assume it could be 12 or it could be 13. That's what they try to actually check. So let's do it this way. When it is 12, you get your NPV as how much? 967. We have tried with 10. We see the 10. It is positive. So if you increase it up, you see here, if you discount it more, like increase the rate of cost of capital more, it will become 967. If you go for 13%, it will be minus 137. So we see that it will be in between 12 and 13. Also, we can see, look, minus 138. So, and here, 967. So I will say it will be close to 12. Okay. Sorry, close to 13 actually. 13 is giving you one minus figure. So it will be in between 12 and 13. And I also believe it will be more than 50% of 12. Okay, let's see here. Guys, what's the story? What's going on? If you guys need to go, you guys can go. I have no problem. You don't have to ask my permission or anything. You're free to go. Maybe you guys are waiting for the attendance. Okay, let me finish it off quickly. I'm almost there. Okay. So IRR is actually 12 plus. So they actually try to find out the gap in here. Okay. So here is 1% into 967. This is 967. The 967 into minus this figure. So this is the way this is the one of the way that we try it. Okay. So this is 12.877, this figure. We have to find out first where is your 2 figures. So one will be positive, one will be negative. Then you understand it will be in between these 2. Okay. In between 12 and 13. So then you apply this thing. Okay. So 0.1 to 12% plus. How much, what fraction will be coming up here? The fraction they say here it will be, this is your 967 divided by gap of these 2. Difference between these 2. So yes, that's how we get these figures. And yeah. Now let's do the attendance. Some of the students are really want to go and they want the attendance to be done. So let's do it. This is for Wednesday class. So today is 29, actually, so 27 in here. So Gurlin Kaur, you there? Gurlin Kaur? Next, Priscilla. Students in here. Okay. So I don't see Priscilla here. I'll say she's
Sir, that's a Thursday class, sir.
Sorry?
Thursday class, not the Wednesday class.
This is, oh, yeah, sorry. This is the wrong class. Thank you very much for
No worries, sir.
giving me that. Good. This is not, this is Wednesday class, sorry. Okay, thank you very much, yes. Okay. So Muhammad Ali here? Yes? No? Okay. No. That's all right.
Yes, sir, I'm here.
Muhammad Ali here, okay, sorry. Yeah. Sarah Jabin, I think she's here, I think I saw her. Janting Chen? Janting Chen? No, okay. Then Anusan I guess Anusan here. Then Michael Gomoski is there? No. Faris Hassan. Faris, I can see Faris here.
Yep, I'm here, sir.
Yeah, Justin High. No, I don't see Justin High. Justin, you there? No. Okay. Then Zheng Yang Huang. No. Anmol Koshi already told me she left. Yasmin Lopez, you there? Yasmin, no. Tarek Obaid, I can see Tarek in there. Anamol Pradhan.
Yeah.
Anamol Pradhan is in here. Jianao Chen. I think I got some message too, right? Utik Panha and another student. Jianao Chen, yeah, he's gone, but he sent me this message. Okay. Then Sullivan. Sullivan here now? No Sullivan, no. I don't see Sullivan. Okay. All right, Sullivan is not there. Yeah. Sullivan is not there. Carla here? No. Then Ifei Shu, I can see Ifei Shu here. Bai Hul Zhang. No. Maha Abdul Rahman. No. Utik Panha, he said he is here. And Chong Yu. No. Chong Yu's name is new. He actually came last week. Yeah. Chong Yu not here now. I think that's it for today. Isn't it?
Hi, sir. My name isn't there. It's Vipul Reddy. It's missing still.
Wait. Let me add your name. But I don't know if I should add your name because you know what? I don't know why the Chongu's name has been added, but your name is not. Vipul Reddy. But I will write it down. But I would prefer the admin do that because I do not have official documents to see which class you have been appointed. Now I have to rely on the students, what the students claim. Okay. I believe you are not. You are.
I don't know. I was in Monday 7:30 class, and then they moved me to Wednesday this class. But I don't know. My attendance isn't there.
Okay, I will write it down, and I will tell them I did this, and I ask them to confirm it. Your name. So let me know if I'm writing the correct way. Your name.
Yep. VIPUL.
That's your registration name, right?
Yes. And
DDY.
No, my last name is K for kangaroo, A for Australia.
Give me K for kangaroo, O for Australia.
N for Nadal.
N for Nadal.
D for donkey.
D for donkey.
A for Australia.
A for Australia.
L for loyal.
Okay. You can send me. You can send me a chat box and send me a message.
Yeah, I'll do it. Sir. I'll do it right away.
Yeah.
Sure. Thank you, sir.
Yeah. People ready, Kanal. That's how I will say right now, and I'll talk to the office tomorrow and ask them to fix it. This is I'm coloring not because to confuse you, nothing to mark you. It's just because that I can talk to the office and tell them, verify them this is correct name. Okay, and you
even my last week attendance is missing. So
Yes, I gave both your attendance. Okay, and here and change the absent today. Yeah, I think Kandala. Okay, yeah, that's fine.
thank you, sir.
Thank you very much. So this is what is supposed to be, and it's fixed. Okay. All right. Attendance thing is chapter is done. Now I will not get any more messages. All fine here. Yeah. Okay, let's move on. So they briefly discuss the advantage of net present value. So yes, the answer is net value and internal rate of return method of project evaluation. So they want you to compare these two things in here. They want you to compare these two things. Okay, NPV and IRR. Compare them in terms of advantage and disadvantage. Okay, so this says advantage. Look at there. The NPV method and the IRR method will both give the same reject and accept decisions. So yeah, both of them give it. It depends like which you want to accept, which you want to reject. It depends on actually which method you are using. Okay, reject accept decision when used to evaluate independent project. However, NPV method is more theoretically nice. Sounds it shows directly when, since it shows directly when a project is expected to increase the value of the firm or the shareholders. So this is one good thing they have. An inconsistent ranking of project by NPV IRR method may occur in situations where the project initial how much initial investment differs. Initial investment is a big issue here, big factor in here. There are differences in the timing of the cash flows of the project. Okay, so the ultimate cause of conflicting ranking by two methods is the NPV method assumes implicitly that cash flows are reinvested at the cost of capital, while IRR method assumes that the cash flow is reinvested at the IRR. So two of them, one is cost of capital rate, another one is IRR, internal rate of return rate, two of them. And neither assumption is totally appropriate. However, NPV's assumption is more correct since net cash flows from a project can be paid debt and equity investors. So they believe the NPV is much more better one. Okay. So anyway, there are theories you can go through these things. Okay. Now another chapter, another one we will talk here is Mishmash Proprietary Limited. I do not think I can finish it off today, but we can try anyway. Okay. So they gave it two net cash flows. Project A is year 0 minus 400, project B is minus 200, year 1 500 and 200. So it means that initial investment for project A is 400 and project B is 200. But the money is coming back in 1 year. I think it's 1 year project only. Okay, money is coming back in 500 and 280. So determine the IRR for each project manually by equating the NPV to 0. So yes, so NPV will be 0. That's how we actually do. Like we say NPV equal to 0. Calculating on that point, we use the NPV formula to calculate IRR. Where we count NPV is actually 0 to calculate IRR. Then I have to find out what is your R. Okay. So this one. So this is 1 year. So equal to this is okay. Look, this 400 is actually supposed to be on this side. You know, it's supposed to be on the other side. So this one should be actually your equal sign. Okay, so that's what they do. Okay, so this is here. So 500 equal to 1 plus. Let's look at here. Future value. Look at here. Future value is 500 for project A. 500 divided by 1 plus R to the power n. And this is n equal to 1. That's why it is very simple. IRR equal to 0.2. But if it goes more than 1 year, then the problem comes up because then you have to take root, cubic root, fourth root. You don't know how many years it goes. Okay. The second year is 40%. Same rule applied. So you can say here. That's how they calculated distance. Okay, the cost of capital at which the firm should be indifferent between two projects is the discount rate for which NPVs are equal. So this said this two formula will be same, but all of them will be the same. how much will be your R? 10%. Anyway, I'll leave it just here. So when they say both of them will be equal, you can say this formula and this formula is same. So these and this equation are same. So this and this equal to same, similar. That time you don't say this is equal to 400. Here, this one 500 by 1 plus RR, IRR divided by equal to 280 divided by 1 plus IRR. From here you calculate the IRR rate. Okay. Okay, guys. I think I'll stop it here now. Do you guys have any question to ask me? No? Any questions for me, guys? No? If not, then I will stop it here.